What's up, everybody? It's your boy, Brandon, back with another edition of the Macro Insights Podcast. But first, before we get started, a little disclaimer. I am not a financial advisor, and the guest is not giving financial advice. So everything you hear on this podcast is strictly opinion and should not be taken as financial advice. We disclose if we have any holdings discussed in this podcast, and you should not be following us as financial advisors. You should discuss this with professionals before you get involved or invested. And as always, it's not financial advice. So please, please, please take this strictly as our opinions and for entertainment purposes only. Now let's get into the show.
Mr. Brandon, how are you doing today?
I'm doing well, man. How are you?
Better than I deserve, can't complain.
I love that, man. You always give that answer, but I love it every time, dude. That's awesome. We got Jim here already as well. I'm gonna see where Bob's at. I just sent him a DM, told him we're about to get started. He'll probably come in, but I kind of want to mix it up a little bit because I know we have CPI tomorrow, but I don't know. I feel like we kind of hit that same talking point every month or so, and we don't really give the precious metals too much love. Maybe they're not as sexy or whatnot, but I think that there's always like a good time to kind of break down the different avenues of investing, because I think a lot of FinTwit kind of focuses on maybe the stock market, or maybe some people focus heavily on real estate or something. So I've been talking with Bob, and I wanted to kind of dive into a little bit more on the precious metals. So we got Bob in here now. So what's up, Bob? How you doing, man?
Good, Brandon. How you doing?
I'm doing great. I'm doing great. Well, we're gonna let I guess a few more trickle in here. Um, but yeah, I was just kind of mentioning we got CPI tomorrow, but the precious metals never get the love that they deserve, man. I think it'll be an interesting conversation tonight, and one that I don't think too many people. I mean, at least on like financial Twitter, like really know how to get into the precious metals market or even like kind of get started. So I think, yeah, just hitting it from all angles will be really nice. So
And I think it's unique, and Bob and Jim, thank you guys for coming in, because when we're discussing like risk-free assets, right? Many people have the notion that a T-bill might be a risk-free asset, and when we're selling these by institution, they're continuously sold as risk-free. But I put a caveat there, because in the definitions of a risk-free asset, it would also imply no third-party risks and solvency needs, and by definition, very few commodities and securities actually offer these types of liability claims. I.e., if we're looking at, let's say, precious metals, gold and silver, they both offer these types of liability claims where it's not inherent on, let's say, a third-party claim and or a third-party yield that's going to be a legal, let's say, justification towards your beneficiary claims upon that security. Whilst with gold, it's unique in that sense when we're really defining risk-free.
Uh, Yeah, you're absolutely right. I mean, the metals are an unloved asset, I guess you could say. But I mean, they get their euphoria and troughs just like most other assets, but it just never really sits in the forefront until unless it's like a banking crisis or something like that. So like what we're seeing in today's world, um, right now in the summertime is it's just gotten really quiet. I mean, that you've had the stock market sort of near its highs, and interest rates have gone up, so you've seen sort of competition with a non-yielding asset, and it seems like everything's just fine and dandy. So the metals have kind of taken a back seat, and seasonally the metals typically get quiet in the summer anyway. That's you got the European vacations, refining, and all that type of stuff starts to slow down. It's not a normal. You start to see a little metal come back onto the exchange. You saw that with the quarter end, into end of June. You saw some deliveries back onto the exchange because metal just wasn't moving. Refiners don't want to have it sit on their balance sheets. They want to earn a little yield on it, so they'll put it on the exchange and sell a contract against it, that type of thing. So you saw some of that come off the exchange. just recently, I think last week. Interesting. I kind of posted today. He had, I think it was like 14% of the platinum in the registered category just left the registered category into the eligible. It looked like it came out of JP Morgan. So I saw the same thing last year, and it was a lot of talk. It was more of an industry related type of delivery, an industry user. So you'll probably see that leave the eligible category, I would say within the week, is my guess. But yeah, it's interesting too. You mentioned the liability claim. Metals are an odd asset class because they're really delving into the world of I don't want to say fear, but just risk in general. So you tend to, when you buy metals, you're thinking, okay, this is an insurance policy, or it's something that doesn't rely on someone else's promise to pay. So it takes on a little bit different role than a T-bill does. Like you were mentioning, it's nice to get that 5% yield. Um, but at the same time, the level of debt's only going higher. And from that standpoint, it's probably the growth the growth of debt is outpacing the growth of precious metals, new precious metal supply coming onto the market from mining activity and scrap. So you have a dichotomy there as well, and so there's a lot of factors that gold investors look at. Oddly, the dollar's been dropping here. Gold really hasn't done much, but yields have been going up. So you have that sort of tug of war that's going on as well. But I think the consensus what I kind of see is the summer is kind of quiet. Things pick up going into the year end, similar to what it was last year. And that's typically, you may see some more volatility in the stock market maybe toward year end. And as we get to 2024, if there's a recession or any type of slowdown that starts, that may start to with these higher rates, that may start to have an impact, in the economy. But I think yeah, the liability claims an interesting point it would be a great way to start off. What I did, basically, my story is that I've been a registered investment advisor since 1992. I run a depository that I own here in Idaho. We have a $700 million all risk insurance policy. We store a lot of assets, obviously, on a segregated basis. And it's a very simple model. It's the client buys the metal, we store it and protect it and safekeep it and insure it. It's not fancy, but it does the job and allows the client to have a limited amount of counterparty risk as possible. I mean, I've looked at every risk out there that I could think of, going concern risk and systemic risk, and just numerous other types of issues. What I'm very pro consumer, pro client in terms of their interests, not necessarily the sponsor or the program or the um, uh, you know the broker dealer, whatever it may be that they're buying into. I really want to see the consumer or the investor, really their interests come first. It's because at the end of the day, without the consumer or the investor, that asset class wouldn't survive. So you want to have more and more exposure, you want to have more participation. And the way I kind of see it is, I wish it was a purist world, but I know there's going to be bad actors everywhere. But in terms of just having the opportunity to people to buy metals, and metals aren't something you own all the time, your entire life. There are certain assets that come into vogue during certain periods of time of uncertainty or inflation, or over indebtedness, or government, confidence in the government, whatever it may be. And those are the times that you see, I think the metals do well. The issue I see in this industry, and I've been seeing it since I started getting into it back in 2006, was it's an unregulated industry. There's not much oversight. When you're dealing with the physical market that's not leveraged, that's paid for in cash, that's outside the CFTC purview in terms of if you're making delivery within 28 days. So they don't really get involved until something blows up. And it's unfortunate. We saw last fall you had First State Depository, which was a depository in Delaware. Initially, the thought was there was about a $30 million loss or so. It grew to about 58 million. I talked to I think the CFTC came out with a release that it was 112 million. I talked to the receivership. They thought it was 75 million, but they ended up, they literally now are going to this guy's that ran the operation, his house, I guess other types of buildings or residences or estates that he may have had, and they're searching everything. So they're finding gold coins under cushions in the ceiling. I mean, it's just, but it's a massive loss. And one of the reasons why I'm very, risk oriented, I guess, and try to, maybe I come across too strong on Twitter, is that I just don't want to see people get hurt. I've seen so many people get taken advantage of by, whether it be dealers or, people that have leasing programs, unregulated type of entities, things like that. And you see hundreds of millions of dollars of people's hard-earned money just gone. Yeah, and I get it. It happens in every market out there. But I think, from a precious metal standpoint, precious metals are sort of known as honest money. Been around since 5,000 years, I guess, or so. I mean, quite a long time. But it just brings a lot of characters to the industry, and you want to try and help educate people so they don't fall into that trap, or they pay too much for metal, or they end up getting exposed into a program they just don't really understand, or they don't understand all the risks. So it makes a lot of sense when you talk about institutions going into T-bills. Sometimes it's just easier to participate with a good sum of money to buy a T-bill than to throw it into physical metal, because most institutions maybe are not chartered to own actual physical commodities. They'd have to go into some structured investment plan or program and then participate it through some type of paper instrument or something of that nature. But I think because of that, it clouds the I think the essence of what the metals actually represent, which is, like you mentioned, it's lack of someone else's promise to pay, that gives you that sort of edge in the metals that you don't have, I think, with most other asset classes.
One interesting thing that Bob is onto there at the beginning of his talk is that he said he's a registered investment advisor. All right. Registered means licensed. Okay. And folks, professionals in registered or in licensed, like securities or futures, it's the FINRA, or the Securities and Exchange Commission, or the Commodity Futures Trading Commission, that mandates that you're ethical with the public. You know your customer, and you know that you shouldn't be recommending somebody trade over what their financial means are. And that's a big part of know your customer. And a shady, shaky guy or gal isn't going to last in a licensed, registered, environment. And maybe you'll see some of those people go to unlicensed things like coin shops or pawn shops or something like that. And there was a big one on the west coast of California that I actually did business with, and I'm not going to mention the name, but he went out of business because he was kind of betting with customers' money, maybe hedging on the wrong way or something like that, and he got caught on the wrong side, and his company went out of business, and by coincidence, another online brokerage started just before I believe he went out of business, and they've got a real strong online presence, and you folks know who they are, I'm sure. And they, I think, inherited a lot of that, a lot of the HTC, HT company, the guy that went out of business. That's all I need to, in terms of identify. And I'm glad that I didn't get caught. But people shortly, after me, they got caught, and He was short, getting people their metal, but he was long, getting customers money for him to play with a little bit. So Bob brings up a good idea there, that if you can kind of check out the people, if they're registered, that means a stockbroker, financial consultant, certified financial planner, futures broker, somebody like that, CTA, certified trading advisor, somebody like that. Certified or registered means they've got to deal within the law, within the registration, within the regulations, and they're harsh. You get caught doing something, and there's fines, there's expulsion, and it makes the news once in a while when a big firm commits does a no-no.
I mean, we just need to look at 2008 and the Big Short movie, right? We saw what happened in in Bear Stearns, essentially, and the big no-nos that they did in derivative markets. But what I like to allude there was simply the notion, and I think Bob also alluded to, the investors' willingness to participate within the commodities market. And it's very much like the Mark Baum claims when he was in that AA meeting, and discussing with the other individual, rudely interrupting everyone. And he says, "What do you do for a living?" And he's like, "I'm a commodities trader." And he's like, "Oh, good for you," right? And I think that a lot of participation has this type of, let's say, misperception across the commodities market. And in reality, now I think is a unique opportunity, because it's for not the first time, but for a significant long time, we haven't seen real interest rates go up at the same time where the prices of let's say, sorry, commodities were consolidative. And that's an important claim, because essentially when real yields go up, essentially we usually see the inverse relationship within the gold market, essentially, and gold would necessarily underperform under these environments. Now essentially I think is a unique opportunity, because to go back to the balance sheet and to investors' willingness to, let's say, participate in cash and cash equivalents within a holding outside of T-bills towards, let's say, gold and or physical gold and or a paper type derivative of gold in that sense. And I think that we're seeing the propensity, especially after the whole movement of, let's say, central banks saying, "I'm going to increase my reserves of gold," towards an institutional will towards these types of developments. And my question to Bob is, have you seen any forms of movements in that turn?
Oddly enough, you've seen ETF liquidation out of the metals, really over the last year. Even I think it was, I think we were at 98 million ounces or so last summer. Now we're down to like 92 point something million. Even when you had the lows back in August, September of last year, um, uh, when metals spiked up into March or whatever, you never saw ETF flows pick up really. It was just really dead. Uh, and the physical market, I think you saw maybe some of that come out of the physical market, especially it was a lot of India buying metals. You saw a lot of metals coming out of the COMEX. You saw a lot of it coming off of London. And I think it was just the world was just waking up. Hey, listen, if you're going to kill the price, I'll take it all, or I'll take as much as I can buy. And yeah, it's just I think with American or Western institutions, I think it's a lot of momentum. I think they're just there is this 60/40 portfolio. There's this commonality that you got two choices: stocks or bonds, or derivative instruments, or something of that nature, or managed futures or something like that. But you don't really get into I think the Western institutions don't really get into the physical metal. It's a shame because if they did, you'd see I think a lot more control of or domination of price of the physical actually over the derivatives market or the futures market, which tends to be clouded with you have commercials which are in there that are hedging or shorting the market, and they could be guys that are playing the ETFs and using the futures as their hedge, and so you got a lot of volume and activity, but it's just you know people running in place going nowhere. You just got a lot of volatility is all you have, and that's a shame because ultimately it hits the mining industry. You've seen costs go up in gold and silver for production purposes, And you haven't seen, like, for example, silver's just been, from an investment relative value standpoint, it's cheaper now than it was in 1970 when compared to the S&P 500 back then. It just has underperformed the S&P 500 big time. But there are times when silver does take off. In 1980 and 2011 were two times when it was actually outperforming the S&P back, going back from 1971 forward. So silver can take off. It's just that it's a shame because a lot of mining companies, just they suffer because their commodity price just isn't doing much because there's a lot of additional trading or selling that goes on, when they pull silver out of the ground and send it through the system. There's just a lot of forward selling, or there's a lot of hedging that goes on the futures markets because someone doesn't want to take any price risk, which is totally understandable. But it's a small market, and that paper market tends to have a huge dominating effect on the day-to-day action. Maybe not necessarily the trend, the longer term trend, but on the day-to-day action. I think that's what frustrates a lot of people in this industry, the physical market, is just that you see the price jump up or down 40 cents in a matter of moments off of a inflation report, and then 2 days later it reverts back. But it's interesting you mentioned real rates. In 2013, when real rates went positive, gold tumbled. I mean, silver tumbled. I mean, that's when it finally broke and went to the downside, was on the idea that the real rates went positive finally. But you're not seeing that now. In fact, actually, the odd thing is you're seeing the dollar go down as we're going into real rates, which is kind of a quandary. I don't know the last time that ever happened, but so there's a lot of things we've maybe seeing for the first time, because of all this money printing and kicking the can down the road for 20 or 30 years. It's having these odd effects, second tertiary type of effects that maybe we don't really think about. And with all this trading activity, that things are moving faster and faster, and so people are gaming the market ahead of these moves. They're trying to front run the Fed. The Treasury is coming out with a crap load of T-bills. They're going to be coming out with more supply. Of course, the RRP program is absorbing a lot of that, but then the Treasury is going to come out and start paying down in 2024 T-bonds. I'm like, well, these guys are going to be running deficits. How are they paying down debt? With that, I mean, it seems like they're just trying to shorten up maturities to make the debt more attractive.
A couple additions to what Bob mentioned is that the institutions, the big banks, if you will, the J.P. Morgans, the Bank of Americas, the things like that. There's Scotia, there's Hong Kong, Shanghai Bank Corp. They've got their own house accounts, so they can take part in gold or silver. But because, like Bob mentioned, silver is a much smaller market, and you need a lot more storage space for a like dollar amount of silver than you do for gold. Gold is the big brother, the big kahuna, if you will. Another addition I'd like to make is that the central banks worldwide seem to have, I don't know if it's a love affair or a bias towards buying gold, except for our central bank. Our central bank likes to buy, guess what? T-bonds. They like to buy bonds from banks and things like that, and they make a market in paper rather than in gold. Now, our U.S. Treasury has 8,133 tons of gold. I think it's on loan, or they've signed a receipt from the Federal Reserve from the 1930s or 40s, whatever it is, something like that. But they don't seem to want to add any physical gold, whereas some of these other central banks, the Russian central banks, the Chinese central banks, India, and some other European banks, they're buying gold, they're adding gold. And for the listeners in the room, you can get on your own gold standard. You can call Bob's company, or you can call other companies online, or you can go to your pawn shop and you can buy gold. You can trade paper dollars for gold, and you can get on your own gold standard, at least for a portion of your net worth, 3%, 5%, 10%, whatever. If you've got $5 million and you're listening tonight, you can buy whatever you want. You can buy as much gold or silver as you want to. I will say that from my experience or my background that silver will lead at some point in this precious metals bull market. Gold is only, it's really only 140, $145 off its all-time high. That was, guess when it was made? It was made a month and a half ago. So that's the all-time high in gold, $2,085. Silver's all-time high is approximately $50 in 2011 and in 1980. So silver has a long, long way, as Bob was mentioning, to get caught up, especially for if you add in, a consumer price index inflation price for silver. It might be. I think Bob said it's the cheapest it's been relative to the S&P or the stock market since the 70s, and he's right. Silver's it's cheap if you factor in inflation. And will it go again? Sure, it'll go again. Now the solar panels are going to use it. The electric EVs are going to use it. Electric cars, soldering, in the wires and circuit boards in your phone that we're listening on and talking to on tonight. They use it. Medicine uses it. It's got a bright, bright future. Silver does. Gold, I guess it's got a bright future, but in a different way. It's just like Bob mentioned. It's an insurance against catastrophe. And gold doesn't really get used up very much. Although, one interesting point, I think in 1995, McLaren Automobiles built a car that was called an F1, a little three-seater hot rod that used gold leaf to shield the heat in the exhaust.
They still do, and they roughly use 10 grams of gold, 10 ounces, sorry, of gold leaf within their cooling systems in their Formula One cars today.
Just interesting, that F1 that I'm talking about was a road car, and they've long since, been out of production with that one, and it's certainly an exclusive collector. But that was one pseudo, in quotation marks, industrial use for some gold, and it was a heat shield. So gold isn't really the big factor if you're going to talk about industrial demand. It's silver is, where 35 or 40% of the silver is going to be used in industry. And I see that number going up in the next 3 years, 5 years, 10 years. And I'm a real fan of both metals, gold and silver, that they can do better.
I think the industry usage is, I think, 60 to 70% by industry. And what's interesting is, for example, I think it was TD Commodities came out today with a very positive longer term forecast on the metals, on silver. I'm sorry. They're looking for maybe toward the end of the year, it's starting to surpass 26, uh, and start to make its move at that point. But they cite, like you were mentioning, solar panel demand, auto electronics, electrification.
Bob, I apologize. You're right about the industrial demand. I was thinking that just the solar panels was approximately 30%. I beg your pardon. You're correct. I had the number.
Sure.
I'm just highlighting the solar panel demand. I believe it's about 30% of the silver mined yearly. Go ahead.
Yeah, and one of the things that they're basically, one of the things that they see coming, which I kind of agree with, is this idea of poor growth in terms of the mining supply and recycling. I mean, as the price of metals, especially silver, stays low, it doesn't incentivize to, if you're a primary silver producer, to go out and start building a new mine and so forth, especially when you got price volatility. You want to see maybe some positive attributes there. But what's really interesting, and I pointed this out, I think, right when this came out. You had the mining in the mine in Mexico that's run by Newmont. They went on strike. This is, I think, one of the largest silver mines in the world. I think it's like within the top five. And this, the mine, I guess, employs, or you have 24,000 jobs that surround this mine, I guess, that are tied to this mine, and it's a huge thing. And so for this labor union and so forth to have the power to be able to shut this mine down, and Newmont just basically close it down in order to do negotiations. What people don't understand is the cost of living is rising in this world. With inflation, we may not, in the United States, we may not see it as bad as the third world countries or developing nations. But the problem is, if labor becomes more of an issue, and they see that this, if they've gone against, the David and Goliath situation, and this labor union is able to renegotiate after they just negotiated a contract last year, and they're able to renegotiate again this year, it's going to give more power to other unions and labor outfits, or not, maybe not just in Mexico, but in some of these countries that say, listen, we want more money. We're putting our lives at risk, and if commodity prices increase, or the profits are increasing, we want a better share of this, because we're just as important. So and that's, you see this with this potential UPS strike. I mean, that's the problem when you have inflation, is it goes through the system slowly sometimes, but it ends up impacting potentially supply chains and other cost factors that maybe we don't necessarily recognize, because we haven't really seen a labor strike in a long time. So that those types of factors are only going to add, I think, as a tailwind to the metals. It's making it more difficult, where the supply or production costs aren't really coming down, and that's going to be a supportive factor, where the metals, when they pull back, they're not just going to crash like it did in 2013. It just, the cost of production is just too much. It's much higher.
I can give everybody a little bit of an update, price update. Currently, the gold is up $2.95 in the front month futures. That's August. That's up about, if you think about basis points, that's up 15 basis points, or 0.15%. The silver market is up 7.7 cents. That's up 33 basis points. The platinum is up $1.95. That's up 22 basis points. Now up 205, pardon me, up $2.05. That's up 22 basis points. And if anybody has an interest, palladium is down $1.47. That's down 12 basis points. I'll give you the Dow Jones futures. The Dow Jones futures are down 35 points. That's down 10 basis points. And the S&P 500 is down 2.4 points. That's down 5 basis points. So that's just a little bit of an update of where we are. Metals are a little higher. Paper stocks are slightly lower from the settlements this afternoon. Go ahead.
Yeah, it's you talk about sentiment as well. I mean, the sentiment is you could cut this stuff with a knife, how negative it is at this point. I mean, you have the retail market, which is just flatlined. The industry is seeing a huge retraction in premiums on the wholesale side. They're seeing a big retraction in premiums, so profit margins are pulling back. Just for example, I mean, there's like less than 40 people that's listening currently on the spaces, if I read it right. Yeah, that's not the, those are what you call a contrarian, uh, sign of, we're probably near a low, and it's, or the low end of the range. And, so it's probably a great time to get in, but that's usually when it's time to get in, but you can't find anybody that has any interest. But that's more of an unsentiment indicator that you watch for. It's just been a very slow environment, and you see a lot of these stories start to pop up, and dealers and promoters are trying to get interest. They're trying to get activity, and they're trying to make a mountain out of a molehill. And I think the biggest one lately was this, Russian ambassador out of an African country talking about, gold-backed currency or something of that nature, and then everybody just jumped on it and ran with it. But nobody else. There was never no I guess corroboration, or it was just basically an RT, Russian Today type story. It had nobody else. I didn't see any other confirmation from any other source or any other country even talking
It's
about
a
that.
little over about a month away, Bob. That might be one reason. Supposedly it's around August 20th or 22nd, I believe. So we may see more about it in the next month or so. But you're right. It started out as a kind of a slow story, and it hit Twitter, and Twitter has certainly repeated it, retweeted it, and other people have jumped on the potential story. We'll have to wait and see what's going to happen. One other thing to agree with Bob again, he and I have a lot in, a lot of our insights I think are aligned. Um, the the silver space will get more interesting for folks that are listening in the room going over 30 or 35 than it is at 22 or $23. It's just kind of like the historic nature of the beast is that people don't really want to buy it on sale. I'm on record on my Twitter uh, history that silver is a gift. It's on sale under $25 an ounce, and it's a gift under $20 an ounce. And the low was last September, the first week of September, at around $17. And we quickly ran up $7 to 24, 25, 26, $7 plus. And the last price on it right now is $23.37. There'll be more people in the room, Brandon, when silver's over $35, if you're going to promote that you're going to talk about metals. That's my opinion.
Yeah, and my question is, when we're looking at actual crustal distribution and geological and topological studies across the world, right? Mainly, we understand that gold has a unique property where it's not necessarily produced internally within the crustal the development of the earth in that sense, while all these other metals have formal deposits and higher depository rates in the calculations and the topological studies that we have right now available to the world. So that's where I think it's very interesting, because even when we're looking at, let's say, silver deposits, there's a unique development where there's an actual increase in silver mining output than we would actually anticipate. And this is a contrary argument to the potential developments to, like, let's say, price activity. Maybe it's an interpretation on a paper market level to say the impetus and movements in precious metals will be found in silver. But I think that when we're looking at the actual bullion and bullion on supply, we see a higher level of silver offered within copper mines, within cobalt mines, within gold mines, and within all these other forms of mines, specifically platinum, palladium, and other forms of titanium as well, because they're just encrusted within these metal developments. And so oftentimes when you see these refiners, they'll have an offset of blanks of silver just waiting to be sold at a profitable time. Whilst when we look at gold, it's a very unique opportunity where there's a very limited crustal distribution, i.e., and the complexities to refining the metal is even higher than any other types of metals in comparison to silver. That
Also,
Yeah,
go ahead, Bob. Go ahead.
yeah, that's a good point. I mean, when you look at the gold silver ratio, where it's was it trading at 83 to 1 or so, 83 and a half to 1 roughly. The natural, I think it's 8 to 1, 8 or 9 to 1 of 8 or to 9 silver ounces to 1 ounce of gold in the ground. So you have this really wide sort of disparity, I guess, between the real world and then, like you were mentioning, you talk about silver, for example, 70% of the silver that's produced is produced as byproduct of other mining, but that 30% it's produced by primary silver producers, that's stuff that you look at the margin, and that's the stuff that can actually create that can have an outside type of price influence if, for example, like we saw with the primary silver producers, their cost of producing, maybe $20, $21 an ounce. Whereas, like you said, if it's a byproduct of other mining, it may just be a credit, an offsetting credit. Um, but the issue though is if you see the primary silver producers having a tough time, keeping up with production because of, they're basically their cost is too high, that can stifle just enough silver coming onto the market that creates that supply deficit. And that's what we kind of saw last year. And I think that's what Metals Focus and was looking at, I think, this year as a another supply deficit that's building because of some of the cost overruns from primary silver producers. Maybe not as much on the like you were mentioning, the mining activity from byproduct from other mining activity.
David. Well, also, I'd like to just address one side note from what you mentioned, and that in conjunction with what Bob said, that a silver mine today, a pure, or if that's their main business, that's their main focus. A silver mine's making $2 an ounce right now. But if my contention is right, and we trade through 27, well, that $2 per ounce profit becomes $4 or $5 per ounce profit. Okay, now you do your PE multiplier, price times earnings, multiple. Let's say it's 15. Well, if you doubled your profit, a silver miner, I'm one off the top of my head, First Majestic Silver, that they mine silver, their share price could go from, let's say it's $6, it could go to $15 or $20, something like that. Well, from 6 to 20 is a pretty nice return. And we'll get more people in the room that are interested. When silver, they won't buy futures necessarily, the people in the room, but maybe they'll have a silver producer, something like that. And by the law of low numbers, silver at 20, let's say it's $23, it's 23 and change, but silver can easily double, a lot easier than gold to double. Gold's going to have to go to $4,000 to double, but at $4,000 gold, silver's going to be, off the top of my head, Bob can give his idea. If we have $4,000 gold, we're going to have $130 or $150 silver. Well, $150 silver for First Majestic, that's 10 or 20x. It's at, let's say it's at $6 today, 10x is 60, 20x is 120. There's some big potential in some of these stocks that people in the room that are listening to us tonight may have. They may have a few shares of something like that, or they may have a mutual fund, a precious metals ETF or mutual fund or something like that. If they've got a futures account and silver goes from, I'll tell you folks, the margin's 10,000 on silver. It's $10,450 on silver. It's a 5,000 ounce contract. If silver goes up $2, that's 1 times your money. You double your money. Okay, so it's $2 times 5,000 ounces is $10,000, and the margin's $10,450. Okay, imagine silver taking out 35 or 40. If you're long 1 or 2 or 5 ounces or 5 contracts of silver, that's the leverage side. Bob can tell you about the physical side. About he's got lower premiums now that he can talk to you about that. And there's a lot more people listening to us tonight in this room that are more apt to be buying silver by the tube or by the bar or by the than there are futures contracts. And I didn't come to sell futures contracts. I came to tell people that silver's got potential. That's what I want people to be aware of.
Yeah, I think it's also important to mention on when it comes to mining stocks, they're a great trading vehicle, but not necessarily a great long-term investment because you have a depleting supply coming out of that mine unless that mining company is successful in growing supply or production elsewhere. It's one of the fallacies of the mining world, and I think and then on top of that, you have a lot of mines, especially juniors and so forth, that I think David Morgan made a great. He did some work into this, and I think it was one out of every 4,000 junior miners actually end up making it. It was just a incredible statistic. So they're potentially great trading vehicles, but you got to be somewhat astute and maybe willing to take profits. When maybe the euphoria sets in. Whereas the metals, I think the metals are definitely going to be volatile, but I think with what we're seeing here, I think the big worry that most people have that's in silver is you have this sort of, you know, when silver moves, it moves like a hockey stick, and when it moves, it's going to be a spike up, and it's going to be, it's going to last, very fairly shortly, and so you got to get out. That's been sort of the sort of the narrative with when it comes to silver. The issue I think is as it builds this base and it's taking this time to develop its price action, that move can be pretty impactful. I mean, it can be very very strong. It's not just simply going up on sort of like a Roman candle, so to speak. It's actually, it's I think like you see with inventories coming down and so forth. It's there are a lot of people that's been participating in silver. I think more than before. I think back in 2011 and in 1980, what kind of happened there was more of a hedging, more in the futures market where you had, the contract roll or short position get blown up, and a mining outfit, forced to cover, and that force of covering just shot the price up very quickly, kind of like the nickel contract in a way. But I think in this one, you're seeing more physical activity globally. This isn't a U.S. centric story anymore. This is every country in the world is a fiat driven society at this point. So there, I think that helps bring in maybe a broader audience that says, listen, I want to protect purchasing power. I don't necessarily need a futures contract. I would just want to own some metal and put it in the sock drawer, and therefore that's something I could have if the dollar does devalue, or there's uncertainty, or that's my so-called bank, so to speak.
That's a very good introduction to tell everybody listening in the room that you can buy the metal, you can buy the coins, you can or bars, you can buy the silver producers or the gold producers. You can buy futures contracts to speculate with a leveraged product, a government regulated leverage product. And there's also, ETFs that you can buy as well. So people in the room have got a kind of a buffet of vehicles to use to, for a percentage or a portion of their net worth or their investment capital to, have a little bit of taste of it when it starts to go. It's my opinion. I think Bob would agree. I can ask Bob. Bob, do you think that the near term meaning 2 to 6 months for silver, do you think it could trade higher from here? I do.
Yeah, yeah. I mean, right now, if you're just looking at seasonality, it's just summertime. I mean, most of the time, it's like watching, like kind of like I was telling a client earlier, it's like being in the middle of an ocean in a sailboat and the wind stops. I mean, you're kind of stuck and you're just kind of drifting. And right now, this is a professionals market at this point. This is, a very technical driven, range bound traded type of market. It's trading off of whether it be economic numbers or potential news events, some things like that. But it's if you look at the charts, it's following channels and that type of thing. It's just not, there's really no fundamental sort of reason or event to kind of drive the investor off the couch to buy metals right now. And it's summertime. People think about vacations more than they think about investments. Most of the time. So that's just simply where we're at. I'm not one that likes to you know clickbait and speculate and that type of thing. I know it gets all the viewers and especially on YouTube and things like that. But I just don't see where that helps somebody. If they're trying to buy with this expectation by the end of summer, this thing is going to be at $50 an ounce. Because of this gold backed currency. I see that kind of stuff on YouTube, and it's unfortunate because it just sets up the client or the customer who's paying for that metal. They're buying it probably at a much higher premium, and it's when it doesn't come to fruition, they just get frustrated. And I think talking to a lot of people the last few months, I've seen more of that, especially from people that bought over the last 3 years from other dealers and so forth, and well recognized dealers, how much they paid, and now the premiums have just collapsed. I mean, you're seeing, where dealers were selling 1 ounce silver rounds for $5-6 over spot. Now they're paying spot for them. There's just, and I've been harping on this, the last 3 years, that there is spread risk involved with buying physical metal. That the premiums are, can be transitory, or they can be, very short-sighted, where they can go higher, but then they can really collapse when either volume drops off, or if the price of metals doubles and everybody starts selling, premiums are going to drop off then as well. So that's why I've always done a very unique job of always trying to keep premiums as low as possible. Basically, my story is that I'm buying directly from the wholesalers. I'm not marking up this product a lot. You can look at my website, goldsilvervault.com. We have a pricing page with all the metals on it, so you can kind of compare maybe to your favorite dealer, that type of thing. And even if you don't want to use that page to try and get yourself a better deal from the dealer that you work with, and say, hey, listen, would you price match? I mean, this is why I do what I do. I want people to get inspired and motivated in this asset class, not be detracted after they buy because they figured, oh my God, I just got taken for a, I paid 30% too much, or I could have gotten 30% more metal for my money if I would have done this, or, that's the part that I see a lot in this industry that I'm trying, I would like to see corrected.
And I think that that's where the big discrepancy comes in for, let's say, an average investor within, let's say, precious metals. And I think physical is, going back to the risk-free type asset, is one of the only risk-free type assets that offer non-third party, let's say, liquidable type solvency within the actual asset class in that sense. And so gold and silver physical bullion offers that unique option. And I think when we're looking at the premium markets, would you like to dive deeper within how premium spreads are looking currently, specifically within gold and silver? When we're looking at, let's say, if I want to buy 10 ounces versus that of selling 10 ounces, what is the premium spread in the purchasing value? How much would your firm currently purchase 10 ounces versus that of selling 10 ounces, if you don't mind me asking that?
Yeah, that's not a problem. Right now, for example, like uh, you look at a 100-ounce silver bar, for example, Royal Canadian Mint bar. That I have it on my sheet at $1.80 over spot, um, uh, uh, or if it's a drop ship, $1.90 over spot. Um, if traditionally when you buy back, it may be between spot, maybe 40 cents over spot, depending on the type of market. If it's a really hot market like we saw, it may be as much as 80 cents over spot. um, but that's one of the reasons why you try to keep these premiums down as much as possible, um, when clients buy, because nobody knows what the bid is going to be when that time comes that you want to sell. I mean, if the price, I see a lot of people, for example, buying, just 3 months ago during that banking crisis, I saw online dealers jam their premiums up, literally almost doubled them overnight when that banking crisis happened. Yes, there was a lot of activity, but I didn't jam my premiums up double. I was half than almost half of what everyone else was charging, even during the height of that. Um, but the problem is you pay $10, $12 over spot for a Canadian maple leaf, and now you can buy the same Canadian leaf at $3.10, $3.20 over spot, and the bid on that's probably going to be maybe a buck over spot or something of that nature, or a buck 50 or something of that nature. Um, you're going to have you're going to have that natural spread, but the real question I think you're asking is, when I go and buy it versus when I sell it, how much risk really is there? Not necessarily at this moment in time, because there's always going to be, a certain degree of spread. Maybe it's 10% or whatever it may be between the bid and offer, or 5%, whatever that number may be. The bigger the bar, the smaller the spread typically, because there's a smaller premium involved. But it's really impacts when people bought Silver Eagles at $15 over spot or $20 over spot from very popular online dealers, and now I'm selling these Silver Eagles at $7 over spot. And I think wholesalers are paying maybe $4 over spot, something of that nature. It's just it's unfortunate, because now the price you paid 15, and if the silver was at 25 when you bought it, you have to get $40 just to break even. And that's just assuming that it's going to be bought back at spot. Maybe it gets bought back a little bit above spot, but those are that's part of what I'm trying to educate people on. When looking at product, if you get into the minutia of product and you say, listen, I love the rounds versus the 1 ounce sovereign coins because they're cheaper. Well, just look at what you're paying, because 1 ounce rounds are just a generic form of silver. There's nothing special to it, versus if you buy a 1 ounce sovereign coin, for example, like British Britannia, or a Silver Eagle, or Silver Canadian Maple Leaf, or Austrian Philharmonic. Those are exempt from 1099 reporting by the dealer. So you have a little bit more, even though you have to declare your gain and loss, that type of thing. You have a little bit more privacy with your information. You don't have to hand it over to your local dealer, because they're exempt from reporting. But those are some advantages that maybe some people see. I mean, if you look at British Britannia's, for example, there's other things that may be caveats that add value. For example, British Britannia's, if you're a UK citizen, those are capital gains tax free on both gold and silver. So if you get into a high inflationary environment in the UK, there may be an oversized demand for that product versus maybe other products around the world. Wholesalers will maybe bid up for that specific product, knowing that they have a very healthy market to sell into over there. So those are things that you want to start looking at when looking at precious metals, not necessarily the insignia on the coin or the round or that type of thing. That's always nice because it may attract your attention, but try to understand some of these other nuances as well.
I think for an average American, it would be, or Canadian at this point, because I see you offer Canadian Maple Leafs, and obviously Canadian Maple Leafs offer a tangible liquidity on a global type scale. So what is the most global liquid type bullion one could enter? I would assume 1 ounce coins.
Yeah, no question about it. 1 ounce sovereign mint coins are the most popular product out there. They're most recognizable. They're legal tender, so that like you have very specific advantages with legal tender product. Like for example, in the United States, if you live in Utah or Arizona, for example, and you sell sovereign mint product, U.S. mint sovereign mint product, there's no state capital gains tax on that sale. So there may be some benefits, and maybe the states start to pick up that momentum and saying, listen, as inflation, grows, or the need for money printing or the need for more issuance of debt, more states recognize that, and they say, listen, gold and silver are money, and maybe their tax policy is going to reflect that. That would be a very big positive for maybe a specific product. But right now, I think those are more geared toward U.S. mint products. And it's interesting because there's a big uproar right now with the supply of eagles by the mint, and part of this problem of this massive premium because of this sort of tightness in eagles out there, there just isn't a lot being made. For example, there's only about 1 million a month or so, or 1.5 million or so made a month, whereas which about 16 million I think eagles sold last year. 10 years ago, there were about 48 million silver eagles made and sold in the marketplace. And so you're seeing the industry, and I've talked about this in the past on Spaces, what's actually happening. It has nothing to do with the U.S. mints just simply ignoring everybody and not making silver and basically giving everyone the finger saying we don't really care about the public. What's happening is there's only one vendor that's contracted to make the silver blanks that then get shipped to West Point, that then get stamped into silver eagles. And that mint, that organization basically has had a concerted effort of dumbing down production and sacrificing that production of those blanks to make proprietary product and also take on other business that may be more profitable. And what that's done is it's made the silver eagle premium much more expensive, which then in turn inflates other products premiums, because people start to say, listen, I'm not going to buy an eagle, I'm going to go out and buy some other sovereign coin, or I'm going to buy a 1 ounce round. And so what's happened is the industry was able to make a fortune off of this situation. That the question is, was the situation by accident, or was there some advantage to the company that was there profiteering that was going on? And when you look at that, it's one of the reasons why when you have an unregulated industry, there's a lot more hanky panky that can kind of happen out there in the marketplace, that I think more than people recognize. And then the promoters kind of jump all over this, and they want to blame the U.S. Mint and get everyone roused up, and then say the dealers come out and say, well, don't buy the eagles, buy our 1 ounce round, because it's 1 ounce of silver and it only costs $6 over spot per ounce instead of an eagle, which is 15. And I'm sitting there saying, well, God, these silver rounds are maybe worth I'm selling them at $3 or $2.50 or whatever it may be. They're just overpricing those rounds because it only costs maybe 99 cents, to make a 1 ounce round. By between buying the 1,000 ounce silver bar, when you do it in size, and then melting that down into 1 ounce rounds, the industry made an absolute fortune off the back of the public. And yet you saw very little of this by promoters and supposed experts in the industry even talk about this. This is sort of taboo to even talk about how the industry is making a fortune off the consumer. And this is something that I'm willing to talk about because I think it adds a lot more flavor, and it provides a little bit more education and insight into an industry that I think could definitely benefit from disruption.
And
Yeah, go ahead, David.
I was just inquiring specifically, Bob, was that the silver market and silver eagles, or did we see this happen within both gold and silver, the market makers in that sense, and the ability to profit off of these premiums?
Yeah, it started with the Eagles. The Eagles, before 2020, the Eagles was the most popular program out there. I mean, it was always one of the biggest supply driven and demand driven products out there. But when you saw in 2020 or so, 2018, 2019, you saw a big slowdown in the industry. Everyone was losing money. Then 2020 happened, and everyone was like, "I'm going to make everything back that I was losing in the last 2 years." And that's when premiums really started to take off. Initially it started with the retail dealers. They not only were they marking up faster than the wholesalers were marking up, they were also going to this interesting pricing mechanism on their web pages of offering giving a spot price that actually was not really the London spot price. It was their own made up spot price that may be 20 or 30 cents higher an ounce than the London silver spot price. And I started seeing this, and I was talking about this on Twitter and on Spaces as well, trying to educate people, say, listen, you're not only you probably massively overpaying on the premium, you're also getting sort of shafted on overpaying on the so-called spot price, and that's unfortunate because you probably had hundreds of millions of dollars that went into profits of the industry, and there's nothing wrong with making money. I'm all for dealers making money. They have every right to do it. It's a wonderful thing, but the question is how much, and how much does it kill the momentum of the industry? Because what started to happen, I think, by the end of you started to see this in 2022, where the you the industry got used to an event-driven market where all of a sudden it goes quiet, and then all of a sudden a news story comes out like Ukraine or a bank crisis, and then everybody flees into the market at once. The premiums shoot straight up instantaneously, and then that business starts to die down again, and then the next story or of the day comes out, and you see another rush of metal, buyers of metal, and so the industry got used to that. And it's one of the reasons why I think in the age of social media and promoters, a lot of people jumped into this market seeing how it was easy to make money off of, because there wasn't any regulatory oversight, there wasn't any licensing that was needed. It was just simply, hey, I can profit by selling bullion or interviewing a dealer, and then I get part of that commission, or I get paid advertising, or I'm going to push a junior miner and make money from that type of. You just saw a lot of this start to come into the market, and it I think the problem with any hot market is when it cools down, you tend to see what people are wearing afterwards, and it's just I think a lot of people just they got burned out. And I think that's what you're seeing now is this market just kind of slow down, and people say, let these premiums come down at this point. I'm tired of overpaying.
So, yeah. So, Bob, why do you think? I guess, do you think that these premiums and these people overpaying is maybe a reason or a detractor as to maybe why the precious metals haven't? It seems like they haven't really gained a ton of popularity. I mean, I've talked to you about this before, but it seems like in 2020 the narrative was kind of yeah, the precious metals were more of an inflation hedge. Obviously, I mean, that's kind of been the narrative for a while, but it seems like, they weren't really performing super well then when, the money printing was going on. Obviously, they're doing a little bit better now, but do you think that that's kind of a reason why people maybe look to other avenues initially, or do you think that, I guess, like the education around the precious metals and buying and selling is just so maybe I mean, maybe not minimal, but like it's not as easily accessible as, like, maybe some, stock buying or anything else. So that's another reason why I guess people were maybe detracted and moving away from the precious metals.
I think there's a number of factors that's affecting this. The advent of structured programs that have come out over the years, these sort of allocated or pooled type of vehicles that attract a lot of assets, where it says, listen, you can buy the metal at very little amount over spot. You can get out at spot or whatever it may be. And so it creates this avenue where, yes, the program goes out and buys 1,000-ounce silver bars, for example, but after that crowd comes in, that program becomes sort of a closed loop system where people are just trading to other people. There's really not much, new metal that's being purchased. It's just regurgitated. Buying and selling. The firm or the sponsor of that program may be making a market and buying that metal rather than selling it back into the market and then go out and buy new metal when they need it. So, that kind of slows down. You see that happening in the wholesale space right now, where I think you've been seeing some two-way action in the retail dealer market, where they've been seeing people that have just been worn out and saying, listen, I want to sell my metal. It's not going anywhere. I see the stock market going back up. I want to participate in that, or I can get 5% in a T-bill with no risk. I'd rather do that than just watching silver flounder. And so you get some frustration. And so I think from what I kind of hear out there is you're seeing two-way business, which means no, you're not seeing as much buying of actual new product. So the wholesalers tend to suffer, and that's why they bring their premiums down, because they're trying to attract business that way and compete with the secondary markets out there. Then all of a sudden you have this race in premium to the downside, to try and attract business. But I think, with the advent of, the futures markets, interesting enough, the futures markets volumes have dropped off since 2020. You don't have the open interest and volume. There's been a steady decline trend line going on in that market. I think you could almost say there's been a deleveraging that's been happening across the board. Yes, you're going to have the derivatives markets, and you're going to see, buffered notes and some of these other types of derivatives brought out by Bank of America, JP Morgan, Merrill Lynch, that type of thing, that are structured vehicles that say, hey, listen, we'll compare SLV to the, GDX, and give you, some type of rate of return based on the better the performing or the worse performing of the two, type of thing. I mean, you see structured products like that, but I think it's, I think what's hurt our industry is just this massive markup in premium. Because I've talked to high net worth individuals that bought from other retail dealers, and then they once they talk to me and they realize and they show me what they paid. I mean, and I was telling them, hey, listen, at that time, this is what I was charging, and I know I was beating everybody on the street by $2 to $5 an ounce on silver. The last 3 years. I mean, these were some pretty big numbers, and people just got detracted. They're like, well, why can't this be like Bitcoin at least? Or that's the advantage of Bitcoin, is you're buying it based on a spot number, and it trades around that number. There's not this fixation of, not only there's the cost to produce the product, to make it, and transportation, insurance, and that kind of stuff. There's this additional premium that's thrown on top of these products because of whether it be profit motive, tightness of supply, or whatever it may be at that moment of time, that doesn't necessarily come back into the product when you go to sell it. And I think that's, people are waking up to that. It's like buying a used car and taking it off the lot. You're like, I have no clue what this stuff's going to sell for when I want to go back and sell it. And I think that's been that's been the tough thing about the physical metals industry, is it is a very opaque market, to the normal consumer out there.
I think that it's, sorry, go ahead, Jim.
I'd like to chime in with one recommendation, and that is, well, two recommendations. Bob does a fine job. He's been at it a long time. Like he said, he's registered, he's got his own vault, he's got access, and his pricing is good. My recommendation to the folks in the room would be, you're saying, all right, well, what should I buy? Well, I would say that if you had a consultation with Bob and he can help you, that maybe Maple Leafs are a little bit better buy than Silver Eagles. Maybe Philharmonics are a little bit better buy than the Maple Leafs, that kind of thing. But if I could make a recommendation that if everybody listening would have a box is typically um, 25 tubes of 20 coins. So that's 500 ounces, a box for the husband and a box for the wife if you're married, and that would be your initial goal. And I would like to see everybody in the year 2023 till New Year's or so, if they could have two boxes, 1,000 ounces for the spouse and 1,000 ounces for themselves. And that could maybe be a goal. You don't have to stop there, but if you had that, I think that you'd find yourself in pretty good shape. If what I mentioned earlier, if gold's going to be 2,500, 3,000, $4,000 an ounce gold, you'd be pretty happy that having something that goes up in dollars and that actually benefits when the price of the dollar is weakening.
No,
So,
you're talking about a monster box of silver and not gold, because if we're
well,
talking about 500 ounces of gold, that's a fairly
no,
big
no,
penny.
no, David. I'm a firm believer that silver is going to outperform gold on a percentage basis, only because of the law of low numbers. Silver is $23 an ounce, and silver, in my honest to goodness opinion, is that a nice move in gold, silver can go 5x, five times. That's $125. Now, I'm not telling you that it's going to happen in 2025 or 2026, but I think gold can be 2,500, then I think gold can be 3,000. I think silver can be 25, then it can be 27, then it can be 35, then it can be 50, and so on and so on. And for the people in the room, if you're a fairly well-to-do husband and wife, and a two-income family with 1.5 or two kids, if your goal could be to have 500 ounces of silver. You could talk with Bob and find out what kind might be advantageous. Bob is well versed with that question on a day in, day out basis. 500 ounces for the wife, 500 ounces for the husband in a traditional marriage. And you don't have to buy it all at the same time. And Bob can probably, maybe Bob's minimum is 3 tubes. That's 60 coins, something like that. But if somebody's saying, all right, I've got all this money in the stock market, I've got 60-40 portfolio, I've got 60% equities, 40% bonds, that kind of thing. Well, I'm here to tell you, folks, if the interest rate in bonds keeps going up, if we have 30-year treasuries now are 4%, if they go to 5%, 6%, 7%, you're going to have a capital loss in your bonds. Okay, so that's my opinion based on interest rates if they're going to continue to go higher. So if I'm just trying to make two recommendations, I think it'd be okay for folks to talk to Bob. He's a good guy. I've known him now for probably 2 years. I talked to him on the phone, and my recommendation would be a box for each spouse in the family, and with ultimately two boxes, meaning 1,000 coins for the spouse and 1,000 coins for the person listening tonight. Go ahead.
You should be a spokesman for the industry.
So
Yeah.
here's the question. So, and I know that this is like often the big problem, and here's where I like Bob's modesty and willingness to discuss this point. I go to, let's say, any big broker, silvergoldbull.com or anything right now, and I try to buy, let's say, 10 ounces of gold. It's gonna price me for the gold buffalo. Let's just say gold buffaloes right now 28.50, 28.20. If I go to resell it, we both know I'm not getting that same premium. This is what you were discussing in the sense that there are certain brokerages offering high and exuberant premiums, and the average individual won't be able to identify where the actual swaps are, in the sense of, let's say, you're mispricing in your actual premiums that you're paying for the coin.
Well, David, just ask Bob what his premium is on the Silver Eagle and the Maple Leaf. They're not $28. Well, they might be 28. Silver. Let's say silver's 23.50. So 28 is significantly lower than it was. It was 12 or $13 over, in the last 3 or 5 months. And I think Bob, did you mention, are you $6 over now or seven?
Well, the Eagles are 7 over. They've been coming down, and I'm a reflection of the wholesale market. So I'm my. You have to remember, I'm not a I didn't come into this business as a dealer. So I came into this as an advisor, as an investment advisor, wanting to basically uh, do the best I can for the client. That's how I was raised in the industry, with compliance and regulation, and someone always looking over your shoulder, and the best practices, all that type of stuff. So I came into this market thinking, well, my model is going to be, I'll just buy from the wholesalers when I need it, develop some really good relationships, which I have, and when I need it, I just don't mark it up, because I'm not used to marking up product a lot. Because as an investment advisor, you make 1% or so on, being in the industry a long time. I used to be a broker as well, but you have a 1% markup in commission on a trade. That's what sort of you're used to, and so there's not a lot of markup. So that's one of the reasons why I don't have this massive transactional mentality where I have to make as much as I can off every transaction, because one, I'll probably never see the money again, but two, that's just my business model. It's how I'm going to pay the bills. So I came at this a little bit differently, where, and I'm willing to talk about this, where I started a depository in 2008. I saw the need for physical metals back then, because I saw, in 2006 and 7, I was doing all the studying. I was looking at everything. Every depository out there at that time was owned by a dealer, a financial institution, or cash and transit company, like a Brinks or a Loomis. So they were all transactional modeled. There wasn't really an independent storage facility that had absolutely made no business off of transactions whatsoever. It was, that was, I never saw that. So I ended up opening, because when you can remove the transactional model from your business model, you don't have the ups and downs of market volatility. You just have a storage fee. And yes, it's not sexy and glamorous and high margin and all that kind of stuff, but it pays the bills. It protects the client. The client, when they pay their storage fee, they know the storage facility is a positive cash flow going concern. It could care less what if the client ever bought another ounce of metal. So it removes some conflict of interest risk and that type of thing from the equation as well. Well, that was my mentality, and I was used to that. It's not going to make me a fortune in the good times, but it's going to keep me alive in the bad times. Whereas a lot of companies end up going under during the bad times, and they make a fortune during the good times. Um, but what for example, right now, for silver, and you were mentioning 23.50 or so an ounce on silver. That's the futures price. The spot price right now, basically, to give you an idea, one of the rates I'm seeing right now is 23.25 on one of the wholesalers on the offer side. So you take 23.25 plus any of those premiums, and that's what your total cost would be. And those costs include shipping to the client or coming to our facility. There's a little bit more, 10 cents extra on the added on to drop shipping, but uh, you try to, again, you're trying to normalize an industry that is not used to that. The industry is designed as a markup, as a transactional model. And so the last thing the industry wants to see is someone stifle their profits. And that's one of the things, that's what makes us frustrating. And I think, there's a lot of programs that have come up, digital programs and other programs that have come up to try and battle this notion of high premiums and trying to create more of maybe an organized structure to it. But then that gets you into a realm of reading the user agreements and understanding, the client's roles and responsibilities, as well as the program's roles and responsibilities, and what risks there lie between the two of them, and what liabilities are there, that the structured program is taking on. And then you have programs that have changed their business model after creating it, where they're they're taking the fees out in lieu of ounces of metal versus fiat dollars. So they turn, basically in turn, start to game against their client base in a way, because if they're taking all their fees out in metal, then the metal goes up. They sell that metal potentially to when more people come into the market wanting to buy, they'll sell that metal and maybe not disclose that that metal was, a principal transaction or whatever it may be. And so they're able to profit more for the company, and maybe not necessarily, pass along the best cost, because they're just basically mirroring whatever the wholesale market or retail market is at the time, even though their cost basis is much lower. But there's a lot of nuances in the industry that are certainly not transparent, but they're most likely never disclosed.
David, if I can just jump in on the transaction fees for in my industry. Once again, I trade leverage derivatives, gold contracts, silver contracts. The difference between buying and selling in silver a contract is a half a cent, and the difference in buying or selling a gold contract is 10 cents. Okay, so there's not dollars over or anything else in their standardized contracts. And once again, most people don't take delivery. It's just you're long the contract or you're short the contract. That's the other thing in futures. If you think the price is going to go down, let's say we spike to $30 and you think it's overdone, you can actually hedge or protect yourself from the price going down, but you can sell first and then buy back at a lower price if it works out, if your timing works out. But that's just the difference on a standard, 1,000 ounce bar, 5 bar contract on silver. It's a half a cent difference between buying and selling. So if you bought it and you sold it right away, you bought it and sold it, you would never do that. But the difference is a half a cent, and in gold contract, it's 10 cents. So it's a very, very user friendly, trader friendly bid ask spread.
I think it's important to note when you're dealing with futures, you're dealing with a derivative, and of course it's a very structured vehicle. There's a lot of regulation involved with the futures markets, and I think I posted today. People ask, are COMEX depositories audited and that type of thing, and they do have a full rule book and guidelines and requirements, not only from the depository side, but Jim could probably tell you also from the clearing member side as well. There's a lot of audit and responsibility that's involved in compliance revolving around the clearing members, and the firms and so forth. But it's you got to be sort of cognizant that you're right. Not many people buy COMEX contracts looking to take delivery because it's a little bit cumbersome. You have to wait till the delivery month, and then you have to kind of as long you have to sit there and wait until a short exercises their contract or delivers their metal to
And
you.
Bob, if they decide to take delivery, they take themselves out of the biggest advantage for futures, and that's they take the leverage away. All right. If you
Mm-hmm.
stand for delivery at $20 an ounce for silver, if you bought it at $20, you've got to come up with $100,000 of cash. If you want to just trade the next month's contract, you just roll the contract forward and you stay with the leverage, and you're still, trading 5,000 ounces for the $10,000 margin. So there's no leverage in taking delivery. If you take delivery, you have to cash, pay the cash depending on what your trade price was, and it's takes the leverage out of the picture. I'm a firm believer that leverage can really help you, provided two things: you choose which way to trade it, and you choose the right time. Timing and direction are the two main uh, issues or that you have to have on your side when you're trading futures. And don't get stubborn if it's going against you. And it's not for everybody. I want to make sure I make that aware. Futures trading is not for everybody. It's for people with sufficient risk capital that want to use a little bit of their risk capital to see if they can make their money work harder for them in a leveraged environment.
Yeah, and leverage is a different world altogether. It's something that you want to make sure that the client has the aptitude, the emotional awareness. I mean, it's a just like trading options. I mean, it can be a roller coaster ride of volatility, and and you get a one-off event that takes it in the wrong direction. It can become a nightmare very quickly. So you definitely want to make sure that you're dealing with something of that money that you can afford to lose.
One, one real world thing that people in the room might want to do if they have access If you're Central Time or Eastern Time it'll be 8:30 tomorrow. Central Time it'll be 7:30. If you tune into like CNBC or Fox Business or something like that, we're going to get a consumer price index report out tomorrow morning, and you'll see how that can affect stock futures. You know, the stock market isn't open until 9:30 Eastern. Well, this report's going to come out at 8:30, but it's going to affect interest rates. It's likely to affect equities, which are S&P or NASDAQ futures or Dow Jones futures. And it may affect gold and silver. And that'll be out tomorrow at 8:30 Eastern, 7:30 Central Time. And you can watch it real time. Make a note of what the futures are on whatever you want to watch. Maybe at if let's say you live in Chicago, maybe at 7:25, and then look again at 7:31 or 7:35, and see if there was a change, depending on if that number comes out friendly to your basis, to what your bias is, and or adverse if the number comes out. And I would say that if the consumer price index is friendly to the stock market, it may hurt the gold market a little bit, but a friendly number for the stock market, in my opinion, talking here on Tuesday night, would likely to be a CPI number maybe below 3.5. If it's below 3, I think the stock market's going to have a real good day. Had a good day today.
Yeah, I know where
Yeah, maybe David or
yeah,
Deerpoint.
I mean, Deerpoint or David maybe has a better insight for this than I do, but I did see a tweet here. I'll post it at the top from Bar Chart earlier today about a report from JP Morgan scenario analysis. They think the most likely outcome is the CPI reading between 3 and 3.2, which will send the S&P, 50 to 75 base points higher. So they have I guess, a 45% probability of that. So yeah, and they, kind of detailed the other chances of where they think it could be. So yeah, I just pinned that tweet in the nest there for those interested. But I don't think Deerpoint's with us right now. I think he's had to hop up. But maybe David might have something to add.
One thing I'll just say, and I think I've said it before, but I'll just restate it. The CPI methodology, one, has found a lot of redundancies. Two, in its revisions within the 2-year methodologies of averages versus now a 1-year average versus goods and services offered within the actual consumer price index. And just to illustrate the mathematical erroneousness, one, it's an actual, let's say, quantity and price index that we're doing, and we're using a Las Perez and Pascal's index quantity, Pascal's quantity index, and the Las Perez actual price index, and we're taking a very specific time. And this is where the erroneousness arises, because mathematically it's only giving you a very isolated picture of the actual time frame that I'm trying to extrapolate. Before the actual 1995 Boskin Commission, there are revised ideas to say I'll utilize gauge theory and a formal topology within the actual economic activities within the major G7 economies and even G15 economies, and that way I'm going to be able to accurately get a better picture of the aggregate demand and supply of a certain commodity and or good versus services within said given economy. But today we use very much so these redundant revisions within indexes. Long story short, I don't think it has a lot of validity. And as we saw maybe in prior times when we had our first reading at 9.1, this is where we had a formal shock. But when we actually look at the apathetic reactions of market participators, we see that the inflows weren't changed, and most market participation is not necessarily taking any weight towards CPI. And specifically today, we know that they're redacting these revisions in order to accurately make so that the methodology is pointing towards their pointed directions within economic activity, which is fairly conclusive towards erroneousness. Okay, for that, guys.
I think that was the mic drop after that. That was great. Yeah, one of the things I was telling clients, when you're in a very lightly traded volume environment, the professionals take over, and you get these really springboard effects or these big drops very, very quickly because there's just not a lot of liquidity or depth in the market. When these numbers come out, it looks like that the CPI is, having a huge outside effect, but what's happening is a lot of it may be, just a lot of algo trading or just day trading involved in general, and then position squaring, and maybe players running the market to run stops to try and exit positions, things like that, that type of thing. So you want to be careful with those types of whipsaws. But I think overall, the mentality, at least from what I kind of gather the last few days, is that the number comes in light. The consensus is that, okay, July is probably the last month they're going to raise rates, and they're going to probably be, somewhat sanguine for, for some time. And that would be positive for the metals. It'd be positive for the markets, and life goes on. Everyone's happy. My thinking is the reason they didn't raise rates on the last meeting was that they wanted the T-bill market to go up, to be higher in yield than the RRP market. So you'd start to see the money coming out of the RRP when the Treasury's been coming to market with a lot of supply. I mean, that's, to me, it's gamesmanship. But I think that's what's kind of that was one of the reasons maybe why they didn't raise rates, because they didn't want RRP to be competitive with the T-bill rate. So therefore, then it was advantageous to buy T-bills, potentially leverage off that or borrow against that, and then you could put that money into something else. But that's just my take on it.
In addition to what Bob said there, I did read that, you remember this budget deficit issue we had here a while back with the government? Well, what they did was they suspended the budget deficit, folks, so they can use as much deficit as they want to. It's been, I think, about 3 to 4 weeks ago is when all that happened. I've heard that they've spent $1 trillion in that 3 to 5 weeks since. So just to back up what Bob's saying, that all of a sudden they created demand because the 3-year treasury is like 4.02 or 4.03, and it was trading 375 or 365, 3.65% in the last 3 weeks or so. So as the rate of interest goes up, you get a few more people, institutions that might be interested. Institutions are, life insurance companies, mutual funds, things like that, fidelity funds, stuff like that. So
Well, you've also had about 400 million or so come out of RRP, the last few weeks, and that helped. I think that provided liquidity into the market, so that treasury supply wasn't absorbed by the financial markets itself. I mean, it blows my mind. I mean, the way they design things in this market, it's not by chance. I mean, there's a lot of structure in here to make sure this whole thing maintains itself. But watching, at some point, the question you have to ask yourself is, why are the Treasury going to start buying bonds in 2024? When you look at, was it the CBO projection, the Congressional Budget Office projections of just, massive deficits for the next 10 years, how are they going to be able to buy all this stuff? And, again, the worry is that they're taking the easy route, which is basically shortening up maturities, which then basically can be collateralized. Maybe it's more appealable to be collateralized and borrowed against to buy more securities. I mean, it seems like that's the world we live in today's world, is, this liquidity that, the Fed is trying to remove from the system. You're having other players adding liquidity into the system and sort of gaming this whole thing, which, that could turn into a disaster at some point, when sort of the party ends, I guess, because at that point there's not going to be the true money supply or liquidity from central banks to support all this potential leverage or wherever this private credit and private money is coming from.
And that would be a tremendous risk, but that needs to be highlighted in that sense. And Charles Schwab's actually highlighted this risk as well. And so I'm going to caveat it where they're saying why the propensity for institutional players to jump into longer yielding T-bills is lower is essentially because of this deficit and the risk in the associations of interest payments and or dividend payouts within the actual prospects of owning these bonds. And so by virtue, they are offering different forms of cash and cash equivalents in associations to long-term T-bills. And in fact, they much prefer, obviously, as you probably know, the rolling around of the 1 year to 3 month T-bills in that sense, because they propose that it offers less duration risk, obviously, but at the same time that they don't propose that this strategy is good for a longevity, because essentially the second that yields turn around and that the environment shift, they're just simply going to go and revert back to a higher risk profile. And this is where the big danger comes in. And your point as to algorithmic trading systems coming into play is fairly accurate. And this was after the rebalancement that we saw in December of 2022, jumping into 2023, essentially, and the consolidation and the apathetic nature that we see of, let's say, passive inflows. And I mean this seriously, because 73% of all market participation in the last 6 months were actually passive flows, and very little was conclusive towards option trading. And the only trades that we saw in associations to zero dated options and market makers were specifically market makers trying to hedge their actual institutional books and associations to volatility risks, and the potentiality of making better returns in the spreads within the offers of these options. And so this is where it becomes very interesting, because when we're looking at the actual exogenous events within market, it's nearly saying we're not anticipating a Volmageddon like what we saw in 2018. And so by definition, this arbitrage play that we're seeing manifested in almost on an intraday market participation kind of systematically respond and say, simply, we're going to work within the inflows and 401k passive flows that we see currently.
But the worry about this, though, is at some point, if the central banks try to cap liquidity or try to reduce it, I should say, you're fighting against, sort of the rule of don't fight the Fed. The market is that what your sense is here? Is that the market is literally fighting against what the Fed really wants, and which ultimately that means the Fed's going to continue to reduce, their balance sheet and money supply to a point where something does break?
So that's where it's funny. We theoretically seeing non-price sensitive institution become price sensitive institutions within their mark to market books and their hold to maturity books. That was a theoretical breaking of a system in that sense. And hopefully that's been mitigated. And the big question here, and I think you just isolated it, was liquidity. The Fed understands that it needs to ensure liquidity needs continuously within market participation, and so they're going to ensure, specifically why we didn't see the S&P react as strongly as it should have when financial institutions were going compressed and essentially having the massive bust that they were. I'm not saying it outperformed, but I'm saying it simply didn't have a circuit breaking type of downturn. And that's very important, because essentially it was underlying within the actual liquidity crunch within underlying securities and index flows specifically. So when we're looking at liquidity, they're always going to ensure that, but there's a significant difference between solvency and liquidity. And understanding the underlying insolvency of market participation is fairly significant, but the liquidity is this veil that they have within market inflows on an intraday specifically, right? And so they're always going to make sure that on the intraday, that liquidity, i.e., is going to be offered. Sorry, I feel like I'm being redundant here. Essentially a big caveat, though, and I think that this is mainly a big misinterpretation by a lot of market participators, and this is also because of the veil that was created by Jerome Powell, simply by the implications that they're saying inflation is our main problem, but in reality, their main problem was the wealth effect, and they really don't want markets to have this massive downturn. And so by virtue, this is a successful, in Jerome Powell's light, rate hike, because when we're looking at the wealth effect, theoretically, we see major passive flows at a positive rate, and in fact, at a very good positive rate in consideration to historical flows and current, let's say, levels at which the actual dollar cost average was acquired, right, in the sense of average portfolios. But long story short, this is always conclusive towards credit utility, and this is where he thinks, I think think that the main problem the Fed wants to correct is this credit utility, and make sure that the credit rotation within the actual the economy is cyclical, and ensuring that the actual market participation is going to be consolidated, so price activity seeing very little volatility, hence why the VIX the VIX currently isn't really representing intraday volatility but longer term option volatility. I'm going to end it there. Thank you guys.
David, I mentioned those foreign central banks earlier. Except for the United States central bank, which is the Fed, they've been buying gold. Well, guess what they've been selling, David, to buy that gold? The Chinese, if as a prime example, they've been selling T-bonds. So they're liquidating some of the U.S. debt. Liquidating meaning they're selling it in the marketplace to somebody. Maybe they're selling it to the Federal Reserve. I'm not sure, but they're taking the proceeds and they're buying gold to some extent, and they have been for several years. So I think that there could be. I like your comment. The difference between, you know, being insolvent and being bankrupt is probably not that many percent of interest. As the percent of as the interest rate, the cost of money, if you will, as that starts increasing, all the bonds that all these companies hold, all these banks, the treasury bonds, corporate bonds, municipal bonds, they lose value as the rate of interest goes up. Well, we're just coming off of 30 or 35-year low in interest rates. And the 30-year bond right now, as they say, it's 4. It was at its low, it was 2.9, I believe, 2.97. Call it 3%. Now it's 4. But it came from in 1980, it was 15. So can it go to 6? Can it go to 7? There'll be a lot of default risk, potential insolvency if we start taking these long bonds up to 5 and 6% again. Hopefully not.
And this is where my primary question within Bob was, what is the true definition of risk free in that sense? And this is where my idea that we only can see it in very few commodities, and gold is a perfect illustration of a risk free asset where, outside of, let's say, price activity, sure, it could be sold at a higher or a lower price, there's always going to be solvency found within that market, and an extra buyer willing to offset that outside of a third party trying to offer you a yield within it. And this is where I think it's the unique opportunity, because when we're looking at actual real yields versus that of, let's say, gold, this is a unique historical opportunity in that sense, where gold is consolidative versus that of having an inverse relation, like you mentioned prior.
Uh, Two comments, David. First of all, please don't forget silver, poor man's gold. And then also, we'll just relay to the people in the room that what gets more important is return of your capital rather than the return on your capital. Okay. And that's what you're talking about when you're talking about gold as the ultimate, asset. If you hold it, there's no counterparty risk. And the Federal Reserve they could have a lot of risk as well. All the bonds that they hold, I don't know what their balance sheet is right now. It might be $8 trillion, something like that. I don't remember if it's that or 800 billion. But if those bonds start losing value, meaning the rate of interest rate starts going up, the Fed can find themselves in a period of insolvency as well.
So this is one thing I'll note. All mark-to-market books, specifically in long-term bond books since 2019, and the acquisitions of, let's say, fixed income, sorry, and T-bills, 10-year T-bills, are all seeing dramatic losses. And in fact, we all saw what happened with TLT and long-term bonds. This is just an illustration within price activity. The inverse relationship between yields and bonds was activated, and if none of these books was appropriately hedged, they all had dramatic losses. But what's important to note here is, implicitly, they were supposed to be price insensitive, but they became price sensitive. And that's where the highlighting between the actual liquidity crunch came into play within the BTFP program.
The reason they didn't hedge, David, is because their hedges lost money for 25 years.
There,
From
absolutely, there was no point to hedge in
there
this
was no point to hedge
environment.
the falling market. And so now we've gone from, as I say, 2.97 to 4.05 or 4.1% on that 30-year bond. And all those 3.5% bonds are a little bit underwater. It'll get a lot worse if they're at 5 or 6. But we'll have to wait and see. I hope that doesn't happen.
But one of the things I try to talk to people about, with the metals is you have to remember gold, for example, and silver, those are both financialized and collateralized. So, higher interest rates basically make a lot of these dealers and a lot of the market makers and so forth and swap dealers, whatever it may be, their cost of capital's rising, but their cost of holding inventory is also increasing, and which then forces a natural deleveraging within our markets. And I think that's what you're kind of seeing. I think that's why you saw a lot of metal leave the COMEX. You had a lot of metal come on the COMEX in 2020. 150 million ounces of silver, I think, at one point in the registered category. That's because interest rates dropped to near zero, and the leasing and capital costs were non-existent. It was profitable to put the metal onto the exchange and start rolling contracts against that collateral. You don't have that anymore. You don't have the ability to borrow money to buy silver, to put it on the exchange, to roll contracts against, kind of like writing calls against it. It just doesn't pay. I mean, you're gonna maybe squeak out 5%. Well, you might as well just throw it in a T-bill for that matter. There just isn't that incentive. So I don't think you're gonna see a lot of metal come onto the exchange with these high interest rates, and that's one of the reasons I think you've seen a decline in open interest and volume over time as interest rates start to rise. You just don't see, you have part of the players not participating in the market. Yes, you got speculators and that type of thing, but you don't have, you see the ETF market slowing down. You have people leaving the ETF market, which probably a lot of that may have been market makers and authorized participants that had metal within that ETF, probably using it for inventory, and then they were just trading against the, taking advantage of the premium and discounts to NAV, and selling and buying shares relative to that premium discount, and making money on a daily basis. Doing that, but as these volume levels have come down, that's not profitable. So you tend to get this sort of quietness before a storm, where activity starts to dry up. And there's an old saying on Wall Street: you never short a dull market. And there's a reason why you don't do that, because if you short it and all of a sudden the price starts going against you and the volumes aren't there and you don't have a lot of people that to sell to, the price can go away from you very quickly. And if you're short, the potential risk is technically infinity, but not that, we didn't see that in the nickel market. They basically cap that one, but you have a lot of upside risk potentially, because prices can get away. And that's what I see. That's been my sort of theory of the last couple of years, is Basel III deleveraging the system, so to speak, trying to put the risk onto the exchanges and away from the banks, getting away from the unallocated programs on London and that type of thing, making it more costly for banks to deal with unallocated type of positioning, more capital requirement there. I mean, these are all things that ultimately make the market stronger over time. The physical market starts to become maybe more dominant, whereas maybe back in, I mean, you look in 2008, for example, the amount of capital that went into SLV during 2008 went straight up the entire year. Yet, the silver got crushed, and it was because of the futures markets. It had such an outsizing effect and dominating price effect back then, because people were using leverage, and then of course the financial system collapsed, and or went into free fall, and anyone who was on leverage just got wiped out. Well, I think that's why you're not seeing these big drawdowns. You don't see, with real interest rates positive, you don't see gold falling apart, because it's not as levered, I think, as it used to be. And that's, I think that's a good thing longer term. I think just it's good for investors to understand that these markets, everyone likes to bash on the commercials and the banks, but their power is sort of diminishing a little bit, as volumes start to detract.
And I think to highlight your point primarily, and I don't know if you know this, but Barclays iPath ETN program, they're not ETFs, they're ETNs, slightly different in how they're accounted within the actual balance sheet, and they're considered as liabilities versus that as assets. And so, unlike an ETF for a balance sheet, they could collateralize the actual ETF. But in the ETN program, they're not able to. It's a non-collateralized collateralized liability that they have to hold upon the asset. Hence, why it actually creates more solvency crunches than we would see. Long story short, just to explain exactly what we saw, it's their commodities issued ETN program. 98% of them became insolvent, and they're no longer offering the off ramps or the actual the off ramps in order to simply perform and or interact within these markets. And that's a huge problem in the sense of institutions offering these actual products, but a big benefit for, let's say, the actual physical asset, because the second that we have off ramps removing themselves, essentially the actual flow of capital remains the same, but the actual exit to that capital is restricted. And so by virtue, what happens to price activity? It's either consolidated and or it goes up. Very rarely would it go and have a misperformance in outside of an exogenous liquidity crunch that would have every performer or every market participant rush for the actual solvency of their assets and securities and associations to the actual market.
Yeah, that's one of the beauties with precious metals, because it's probably it's one of the few financial assets that can be hoarded. I mean, it's an odd asset class because it's dominated not by the actual physical product, it's dominated by the derivative price action, in a lot of instances. Or but this this idea of higher interest rates is throwing sort of a wrench in this whole narrative of, because people are starting to, they are deleveraging during this process. I mean, I don't want to say the general market, because yes, the margin debt's probably rising and people are borrowing, they're repo, or they're borrowing against T-bills to buy more securities, whatever it may be. I mean, but just in our small world of the precious metals, that's one of the reasons why you have to be very cognizant of the structured programs that you deal with. If you're invested in some of these programs that have leasing, for example, or borrow against your gold programs and things like that, you have to be very careful with those programs, how well capitalized they are, how much of that revenue is supporting their business, because that revenue can dry up very quickly or go against them.
On the delivery question, Bob is right. If you were a client, I'd let you take delivery of gold. It's a 100 ounce bar, or silver. It's 5 1,000 ounce bars, provided you're suitable, to trade it, and you've got the money to affect delivery. You can put 5 1,000 ounce bars of silver in your closet, but you would never, never, ever asked me to take delivery of crude oil or gasoline, or a contract of wheat or soybeans or corn. Crude oil, folks, your swimming pool isn't big enough. Trust me, it's 42,000 gallons of crude oil. The average swimming pool is around 11,000 gallons. Your neighbors would hate you if you asked them to drain their water and put crude oil from a crude oil contract. Actually, I'm teasing, of course, because they stay in Henry Hub storage. But gold and silver, you can actually take delivery of.
Yeah, and on the gold side, actually, you can 3 gold kilobars actually are good delivery against the contract as well.
Yeah, this has been a very insightful and great conversation. I want to be cognizant of your time, Bob. I don't know if you want to keep going. Maybe we could take some questions if people in the crowd have some. But we've been ripping and rolling for a couple hours now. So, Bob, if you got a little bit more time and we have questions, I'd love to field some. But if not, we can wrap it here in a sec.
Yeah, I have some time if anyone has questions.
All right. Yeah. Feel free to request the mic if you have any questions for Bob or Jim or David or myself. Yeah, we'll leave it like a little bit of an open forum here. But in the meantime, I will be putting this, I believe, on my YouTube tomorrow. So I'll get the audio file and kind of put it up there. So for those who are wanting to play this back, obviously it's recorded here on Twitter as well. But sometimes the spaces get a little messed up from the recording, so put it on my YouTube. So be on the lookouts for that. And yeah, I give Bob and Jim and David all up a follow here as well. Yeah, these are three greats, and I always enjoy talking to them. I've learned a ton this conversation, so I apologize I haven't been super active in this convo, but yeah, this is very insightful, and I don't think a lot of people really understand this side of the industry and everything like
And
that.
if anybody in the room wants to take advantage of my recommendation, maybe Bob could at least give out not his email, but his website where they could get in touch with Bob to start purchasing their boxes of silver. I'm sure Bob would be glad to, help you with guidance, that kind of thing. Once again, I recommend a box for you and a box for your spouse if you're married. That's to start.
Or in this day and age, a box for your significant other. But yeah, our website is goldsilvervault.com, VAULT. I think it's on my profile too on Twitter. So, feel free to kind of browse through there. Certainly, use it as maybe as a little bit of a guide. We just revamped the website too. So there's uh, you know, it's a little bit more, maybe for some people it's a little bit more user friendly, but we try to just give sort of some good pointers out there. Obviously, feel free to give us a call. Our numbers on the website as well. So if you want to give us a
And
call, that'd be
Bob, can
great
you
too.
just confirm to people in the room that you don't have any trouble at all shipping out a box or two boxes of silver that they might choose to buy from you after consulting with you tomorrow or Friday or something like that? You do this day in and day out.
Yeah. Basically, what we do is we basically have it drop shipped directly to them from the supplier. So I wanted to do that because it tends to reduce the sort of chain of custody, I guess, or it reduces the chance of error rather than shipping it from one location to us or to another location, then it gets shipped out from there. When it comes to from the supplier, that supplier is going to be an authorized distributor for that mint or refiner. So that product has a very strong chain of integrity there. So when you do get the product, that this if you buy a sealed mint box, it's going to be sealed and intact. It's going to be brand new. Those are the advantages, and plus everything's obviously insured from point to point as well. So it's an adult signature required. So that, which is very typical in the industry. I think everyone kind of practices that. But yeah, it's just I think feel free to kind of peruse the website, give us your thoughts, that type of thing. I always try to put some stuff out on Twitter as well. So stuff that may be helpful or timely, or for example, price wise, like today, I think we saw some prices coming down on a couple of popular products. So I tend to put that out there so people can kind of see that as well.
He's here to help you, folks. He honestly is. He's a good man.
And thank you very much, Bob and Jim, for the conversation. It was an immense blessing in that sense because obviously the gold and silver markets tend to be slightly more conservative and, as we just discussed, slightly underappreciated in that sense. And most investors, and specifically the average retail investor, don't understand the potential value that it would offer. Specifically, as well, we didn't go much into it, but the tax accountings that are offered within the actual holdings of these assets. But we did get a couple of questions. So Buffalo Nickel, yeah, and then A is on deck. So Buffalo Nickel, ask your question, and then A is going to be coming on deck.
Yeah, would you guys recommend the eagle or the buffalo in terms of tax implications? And I mean, I had a couple eagles that were discolored, and I find that buffaloes are more the same. That's more of a comment, but have you guys ever run into that issue where the eagles, they weren't the same consistency?
What were you referring to? The buffalo, like
The
silver
22
buffalo
karat versus the
rounds?
24 karat.
Oh, on the gold side, yeah. I mean, from a tax standpoint, they're both treated the same. They both have, if it's short term oriented gain of whatever your income bracket is. If it's long term, it's going to be 28% collectibles rate. Is that what you were
Oh
you
yeah,
were asking?
yeah. So there's so I heard, maybe I think on the 2 is 1 YouTube channel, that the Eagles, the 22 karat gold is taxable. Maybe that's just wrong information.
No, they're both taxable. I mean, they're from a federal standpoint, capital gains tax standpoint, they're both taxable because uh, it's a collectible. I guess it's taxed under the collectible rate system. It's not a security, so it's not taxed as a capital gain from a like you see with like some of the closed-end funds and things like that.
Okay, interesting. Yeah, I'm a big fan of gold and Bitcoin. I believe that self-custody is the way to go here.
Yeah, it's there's a big saying out there: if you don't own it or you don't hold it, you don't own it, type of thing. Which I'm very supportive of that. My appeal is just that there comes a point where maybe you take too much exposure by holding too much at one location, maybe within arm's length, and that actually ends up adding risk to potentially you or your family, or the risk of uninsuring it because of your homeowner's policy. You'd have to get maybe a rider to that policy, and that rider can only go up to so much. And by the time you pay that extra insurance, you might as well just you could find a professional facility that would store it and insure it for you. But yeah, I'm definitely supportive of that.
Hi guys. Hi guys. I have a question for Bob. Do you have any opinion on Canadian gold mining company like Barrier Gold or Pan American Silver, provided these are traded in Canadian dollars? Like lately, they've been quite low price wise. I mean, on per share.
Yeah,
Yep.
Yeah, I'm not real into the mining companies. I kind of become more of a specialty. I specialize more in just in the physical metals themselves. I've been in the business for 30 years. I've kind of seen that the mining companies are more of a trading vehicle, whereas I kind of call it mining companies are more timing oriented versus metals are more time in the market. So I try to simplify the portfolio with physical metals. It's not going to
Hmm.
be the big leverage returns that you may see like with some of these mining companies, and there's certainly a lot of good ones out there. But yeah, there are a lot of good analysts out there. I think David Morgan does a lot of good work in that field.
Okay.
There's a lot of guys to follow. SRS Rocco report does a great job of going through some of that stuff. There's a lot to name here.
And what about gold price and silver price? Let's say for the next 6 months, what is your opinion? How far can it go?
I think right now they're both really stuck in ranges. You're seeing potentially toward the low end of the range right now. So, you could basically see, silver trade between, like, sort of the consensus I think is around, maybe 22 to 26 range,
Right.
where it starts picking back up toward the end of the year. Gold, in this sort of 1880 to, potentially back up to 2050. I think that the issue though is the moment the metals. I think if they do bottom or find a low here, I think then there's going to be if they start to walk back up. If the market got short at all or is under invested, it sets up a potential where the illiquidity is going to come to the short side, meaning like what we saw in March of 2020 when the market went down really hard
Right.
with COVID, it blew out all the longs, and then all of a sudden, they shut down everything, and all of a sudden, if you're sitting there short on the market on the COMEX, but you're long physical, but you can't get the physical, you got to close out your short contract because you can't actually get to your physical, and that short was a hedge. All of a sudden, you had to start closing that out, and that means you had to buy back, and
Right.
the liquidity dried up, and it forced the market up higher very quickly. And I think that's what we're potentially is ultimately going to see when you typically see that when silver goes like a hockey stick. That's kind of what's happening there is liquidity is drying up on the short side. So that's where the risk starts to rise, meaning the price goes up against those shorts.
I would
Right.
also
Right.
I
And you was mentioning previously that you believe that Fed not gonna increase interest rate anymore, so that should be favorable for gold and silver, right?
That's yeah, that's the sort of the consensus out there, is that the industry is kind of watching for some sort of
Trigger.
yeah, yes, at some point the Fed stops, and everyone's watching for maybe the economy to slowly recede. Maybe because the problem with using leverage in an economy is it there's time delays that happen. It's like having a party or whatever, and as the longer you go through the night, you start to wear out. Well, the economy is like that. When you start raising rates and everything, you may not get the effects right away, but maybe 12, 18 months
Right.
later, that's when those effects start to, and so all that starts to compound. I mean, you have the issues with what Canada with because a lot of their mortgages are more of variable rates, so those rates are going to be
That's
resetting,
right.
all that kind of stuff, and you have that throughout the world. But that that's where I think it's at some point the U.S. government can't afford too high of rates, because the debt servicing is going to kill them.
That's
I
it.
mean,
Yeah,
and it's a very basic, keep it simple. If you can't write it on the back of a business card, it's not worth investing in story. It's really about debt servicing and making sure the federal government's the Fed's job is to sustain the federal government at this point. That's so I think if they're trying to, the smart thing would be is to try to go out in duration, but maybe they're not going to go out in duration until until they can. I mean, who knows what's going to happen in terms of longer term yields. But the emphasis on the precious metals markets is it's not just the United States anymore. This is a global phenomenon that you're seeing a lot of countries in trouble. And they're really crying to their central banks, you need to support us, or support our spending. And that's
that's right.
that's what makes this market kind of interesting.
And I mean, lately, if you obviously you follow the economy, we went through liquidity crisis, then we got into credit crisis. I mean, it's currently a credit crisis, and I believe in 6 months we're gonna have an earning crisis because people stop buying. People cannot spend their money on non-essentials, and eventually it's gonna hit general companies that do retail and obviously like general companies in general, right?
Yeah, I mean, don't forget you have the student loan issues now. They're going to have to start paying back their student loans, what, October or September.
Right,
But you've had these moratoriums the last 2 3 years of rent or mortgages or car
right.
payments and whatever it may be, and that's basically that gave discretionary income to spend in the economy. But that's
It's
temporary from a
about to
long term
disappear.
perspective.
Exactly. That's right.
Yeah,
It's about,
right.
yeah, and
Yeah.
like I said, I work for FedEx Freight in Canada, and we see about 30% down on volume per truck. Let's for the last 3 months, just to give you an example, if my truck would go out with 10,000 pounds to deliver, now we're going about with 7,000 pounds, 5,000 pounds. So we have the same set of customer. Let's say in Montreal we have 100 customers that use FedEx Freight. We still have the same customers, but they order 30% less. You understand what I mean? People cannot afford hold or have a big inventories anymore. It's just because
Yeah.
final customers they don't buy anymore. Basically, less people buy.
And you see the same thing in the physical metals market. You're seeing, people not holding as much inventory because the cost to hold that inventory is becomes more
Right,
expensive. And people are slowing down spending, or purchasing of metals, just like you see, I think, in probably other areas of the market as well. So, unless there is an event or something like that happens. But yeah, so you're right. You see a lot of sort of similarities, I guess, with your business and what I see with our business, or industry.
yeah, it's about the cash flow. Cash flow, it's about to disappear. Actually, people gonna spend their money on essential, and that's about it. And obviously, in 6 months or a year, it's gonna hit general businesses. Yeah, that's about it.
And
Exactly.
All right.
Sure.
thank you very much, A, for that. But I think, Bob, there's another question that I want to
All
bounce
right,
off,
guys.
and then Raybon is on deck here.
Yeah,
And
thank you.
let's please not. Thank you very much, A, as well. And let's not have any trolling. Hopefully, Raybon, that's not happening with us. But long story short, the actual holding versus that of the premiums, we're seeing if supply and demand, and I know that we've had a couple of periods, but again, if supply and demand comes into play, are we more at risk to saying that these, let's say, market makers and or individuals such as you in a position where selling volume might come into play, so you're willing to offer a higher premium versus spot because, let's say, the premium on a gold buffalo might be higher at the time and the demand for that gold buffalo might be higher?
Are you saying that if people start selling back, what the premiums would do?
Well, sorry, I didn't really answer the question appropriately. If we see continued, let's say, withholding of stock and less stockpiling on the actual market makers in that sense, and a price event where, let's say, a lot of liquidity is then found onto the market, would you think that, let's say, if demand is suggestive for a gold buffalo, apologies for this, you would see premiums go higher for that gold buffalo? I think we saw it like happen maybe 12 months ago.
Yeah, no, you're absolutely right. The market quiets down, and then you saw that in 2020 was a perfect example because 2018, 2019, everyone's losing money. Everyone's trying to sort of draw their inventory down, and all of a sudden, out of nowhere, you had COVID happen, and it was just like game on. And in the market, the industry was on a back step that whole time because it was so used to a dead market. What's happening now is the retail dealers, if they're not if they're seeing two-way action, they're not buying that metal from the wholesaler. That wholesaler is not buying their metal from the mint directly. So the mint all of a sudden now is backing up on product, and now they're forced to lower premiums. That starts a chain that comes back reverberates back down to the wholesaler, that then reverts back and ultimately hits the retailer, because now the retailer has to compete with lower premiums, not necessarily on the offer side but on the bid side. And so maybe the retail dealer has less transparency. The public has less transparency on the retail dealer side, but on the industry side, this goes up and then back down the chain as things start to slow down. And then at some point premiums will come down enough where it equalizes, and then maybe people say, okay, premiums are cheap and the price is cheap. Now I'm ready to buy again, and then the thing starts. That's typically how the industry works.
He's telling everybody in the room that it's a good time to buy a box.
All right. Well, we got Ray Bond, man. Let's see what you got, man. What you got for Bob?
Yeah, I'm just wondering, what do you think will happen, like, let's say 5, 10 years from now, if I can just load money into a Bitcoin wallet and let it sit there for a day or a decade? What's going to happen? Like, as that continues? Because all the rent-seeking behavior, like, eventually it's going to come to roost.
Yeah, I don't follow Bitcoin as much, so I'm probably not the right person to talk to, or maybe mention anything there.
Brandon's the right guy.
Yeah, I think you'll be sitting pretty. I mean, I don't know. Self custody is probably the way to go. You know,
Yeah, that's what I mean. Like, how is it?
what do you?
I
I
just
don't.
I just look at it, more and more people are going to realize, like, okay, I can hold on to this
Yeah.
townhouse or this apartment and pay taxes and maintenance and be like, I want to be a landlord, but it seems like a lot of people are realizing they don't want to be landlords, and they're
Well, yeah.
realizing that the actual return on investment is extremely uh,
Well, I think.
it's the kind of thing people are gonna wake up to more and more. Like a Bitcoin wallet balance, there's no one charging you anything for any amount of years, you know?
Yeah, I just think that there's differences in goals on like what you want to get out of investing, right? Like, if you need I think there's a place where, precious metals could be, like Bob has mentioned in the bad times, right? If you're looking for something that, you're not going to be able to hold on to for maybe like 5-10 years or something, and you need to ride the waves of volatility. The precious metals could be a way to kind of eliminate some of that volatility, or real estate, for example, because you brought that up. I mean, you can be able to get cash flow or some appreciation on mostly borrowed money in the United States. You have to pay taxes on that by owning a home, but
That's what I'm saying. Are
there,
you sure the return is going to be anything significant?
well,
Like,
I mean, it depends. I mean, there's a lot of people that make a lot of money in real estate. I mean, um, you can get cash flow, right? And there's also like tax benefits of owning real estate that people don't really talk about, right? I mean, like President Trump has famously, didn't show his tax returns, but basically he was able to pay little to no taxes because of depreciation. There's also, like 1031 exchanges and other things like that that are, pretty advantageous to own real estate in the United States, at least. So, I mean, I think that there's, like I said, there's room for everything in there. It just really depends on what your goals and what you're, looking to get out of it. If you're looking to get out of, the most return on your money that you're putting in, right? I mean, I think Bitcoin has the lowest barrier to entry, and if you don't need to spend that money in the next 5 to 10 years, it's
yeah, so
pretty.
what's going to happen when the next two generations don't own any of the real estate or anything else? They're going to
Yeah,
realize,
obviously that's going to be pretty terrible, right? I mean, if BlackRock and people like, I don't know, Bill Gates and other these billionaires keep scooping up real estate, it's not going to be good. It's not going to be good if they kind of scoop up all these other precious metals or commodities or other things like that. I mean, it's never good if it's not really evenly distributed. So I mean, I own Bitcoin, and I'm a very I'm Bitcoin guy, so I see the argument, but I also see like, all right, if you need to have some sort of cash flow, right? If you want to retire, real estate's a good option for that because you can get a lot on like I said, like borrowed money. You could have tenants pay down debt, and you can get some money that you wouldn't be able to get. Whereas Bitcoin, if you were to invest your money in that and you quit your job, you would have to theoretically sell off right now as it
what if
stands.
you plugged into like a natural gas well and you just did that instead?
I, I mean, there's different options for
Then the
different.
machines are pretty static. They're kind of like, I
Yeah,
like
but
to compare them to a well of some kind
cost, right?
themselves.
Everything has an overhead cost, right? So you would need to sell. It would be based on that. I mean, I don't like mining isn't necessarily the best business to get into right now with,
You'd rather
I
be a
think,
landlord?
well, I mean, there's risks to everything, man. I mean, I don't know. I'm a landlord myself, so I think, it's not as big of a headache as you might think it might be, to be honest. So, um, I like I said, I think that there's different options for everything, but I don't want to I don't want to waste too much of Bob's and everybody else's time and listen to this kind of conversation. So I think we'll move on to the
Why, do
next.
you feel bad for being a landlord?
No, I don't feel bad at all. I mean, I provide a great home for people to live in, and yeah, I'm very responsive, and like I said, I don't feel bad at one bit. All right, Civ, what you got for us?
I was just listening along. I would say like if it's between commercial or landlord stuff, I'd say read the 1930s acts as it relates to ag because it has 7 year look back, right? So you can, if you paid taxes in the last 7 years, you can buy like if it has water rights and like secure infrastructure on a ranch, you can actually do way you can leapfrog anything you can do with commercial or any sort of real estate. I think that time has passed. All right, I'm gonna mute
Yeah.
myself.
Yep. No, I appreciate that. I mean, like like I said, I didn't want to get into this like the real estate discussion or anything like that because I have Bob here to talk about his specialty in the precious metals. But I'll kind of like wrap up this section of the conversation. like I said, I think real estate is good in a sense. There's, being a landlord shouldn't be as, I guess, demonized as I think like some people try to make it out to be. Because you're basically taking all of the liability away, from a potential tenant. So, yeah, I mean, you had to pay cost. Everything costs money, and problems when you have homes, generally speaking, have an extra zero behind them. So, yeah, I'll leave it at that. And I don't really want to get in this conversation anymore, Raybon, man. So, I mean, if you want to have this conversation, we can, discuss it in a different space or something else. But I don't want to take up Bob's time on this. So, but on that, Bob, why don't you plug, where people can find you and yeah, contact you. And like I said, I'll put this up on the YouTube tomorrow.
I appreciate the opportunity again. Hopefully that this was helpful for people to kind of understand the industry, understand just what's happening in our world, I guess, of the markets, in terms of activity and just the trading that goes on day to day, how that affects price action, that type of thing. Certainly feel free to check our website out again, goldsilvervault.com. There's we also, I've done interviews and done spaces before where I think we have them posted, or I think on YouTube as well, but certainly feel free to listen to those. Try to provide timely information or education in terms of maybe what to look for, what to what to watch out for. When you're investing in the markets or investing in the metals through programs or securities, things like that, what to maybe look out for in terms of red flags, to try and understand what you're investing in a little bit better. But certainly feel free to send me a DM on Twitter, or I think our phone number is right on our website, so you can feel free to give us a call as well.
Awesome stuff. Yeah, be sure to check out Bob and his team at goldsilvervault.com. And yeah, Bob, thanks so much, man.
Sure, I appreciate it. Thank you.